I believe that the market currently is concerned that we might be seeing a de-anchoring of inflationary expectations. In the last few weeks, perhaps even several months, we've seen a significant rise in so-called break-even rates, which measures the market's expected inflation over time. So the benchmark 10-year break-even rate has now reached levels of 2.53%. And I fear that the market is beginning to question the Fed's ability to anchor or continue to anchor inflationary expectations. And I think that has consequences right across asset classes.
Okay, walk us through those consequences then. If this is to be the case, I mean, what do you want to do in reaction to this?
Well, I think first and foremost, you have to recalibrate a lot of your relative valuation settings across your portfolios. And we know, obviously, that so-called long duration assets, and technology shares fit into that bucket, are going to witness a recalibration in a relative valuation sense, and particularly those companies that have very, very frothy expanded price earnings multiples. And I think that's what we've been seeing now for a couple of weeks. A lot of the more speculative tech shares have seen very, very significant price declines. And don't forget, investors around the world have predicated their portfolio construction upon the expectation of low and stable inflation. And now we have a regime change in terms of both monetary and fiscal policy, which, all things equal, Nancy, I think leads to higher inflation. And perhaps it's not quite as temporary as Jerome Powell suggests that it is.